You've been diligently saving your entire working life, playing by the rules, and looking forward to the day you can finally relax. But the moment you cross the threshold of age 70 and a half, the IRS quietly shifts the rules of the game. If you aren't paying close attention, the very retirement accounts that were designed to protect your wealth will suddenly become a massive tax liability, triggering higher Medicare premiums, forced distributions you don't even want, and taxes on up to 85% of your Social Security benefits. However, buried deep within the IRS tax code are a handful of specific provisions that activate the moment you hit age 70 and a half. Today, we are going to walk through 7 specific actions the IRS legally allows you to take right now that most retirees have no idea even exist. One of these moves can entirely erase the taxes on your required minimum distributions. And the final strategy we will cover can literally reset your required minimum distributions altogether. You need to pay close attention because the laws have changed dramatically leading into 2026. If you follow the outdated advice from just a few years ago, you could find yourself handing over a massive portion of your life savings directly to the federal government. I have seen too many hardworking people step into these invisible tax traps simply because they didn't know their options. So let's get straight into it and protect what you've built. We are going to start with a strategy that completely bypasses the standard tax brackets. Imagine being able to pull money out of your IRA, use it to support a cause you care about, and completely erase the tax bill that would normally come with it. This is not a tax deduction. It is much more powerful than that. It is called a Qualified Charitable Distribution, or a QCD. For years, financial advisors told you to take money out of your IRA, pay the income tax, and then write a check to your favorite charity, hoping you could write it off. But because of the recent changes to the tax code, most people take the standard deduction and get absolutely zero tax benefit from their charitable giving. You are effectively paying taxes to give your own money away. But the moment you turn 70 and a half, the IRS unlocks the QCD. By using a QCD, you can transfer up to $111,000 directly from your IRA to a qualified charity in 2026. The money never touches your bank account. It never shows up on your tax return as income. It completely bypasses your adjusted gross income. Why does that matter? Because your adjusted gross income is the domino that knocks over everything else in your financial life. If you just take the money out and donate it yourself, that withdrawal spikes your income. That spike can push you into a higher tax bracket. It can trigger what is known as IRNAA, which is a surcharge that dramatically increases your Medicare Part B and Part D premiums. It can also cause up to 85% of your Social Security benefits to become fully taxable. By using a QCD, you keep your adjusted gross income artificially low, protecting you from all of those phantom taxes. And here is the kicker. Even though you are allowed to start doing this at age 70 and a half, these distributions count toward your required minimum distributions, or RMDs, which don't even start until age 73 for most people. That means you can begin aggressively draining your IRA of future taxable funds, giving to the causes you love, and completely sidestepping the IRS. Did you know that over 60% of retirees who give to charity do so using cash or check, completely missing out on this tax loophole? Think about the thousands of dollars being surrendered to the IRS unnecessarily. If you are 70 and a half and you are giving money to your church, a local food bank, or an animal shelter out of your regular checking account, you need to stop immediately. Call your IRA custodian, request their specific QCD form, and have them send the check directly from your IRA. It is a simple administrative switch that can save you thousands of dollars in taxes every single year. But what if you want to give to charity, but you also want to make sure you have enough income for yourself? That brings us to the second strategy, which was recently introduced and is virtually unknown to the general public. It is a one-time $55,000 split interest distribution. It sounds complicated, but it is actually a brilliant financial lifeline. A standard QCD requires you to give the money away forever. You get the tax break, but you lose the cash. However, under the Secure 2.0 Act, the IRS now allows you to make a one-time transfer of up to $55,000 from your IRA into a charitable gift annuity or a charitable remainder trust. This is how it works. You move the money out of your IRA, and just like a standard QCD, it does not count as taxable income. But instead of the charity just keeping the money, the charitable gift annuity pays you a guaranteed fixed income stream for the rest of your life. You are essentially taking an asset that the IRS was going to force you to pay taxes on, turning it into a lifetime pension for yourself, and when you pass away, whatever is left goes to the charity. You get the upfront tax benefit, you get the lifetime income, and you get the charitable legacy. If you are married, you and your spouse can each do this, meaning you could move $110,000 out of your taxable IRAs and turn it into a joint income stream. The tension here is that you only get to do this once in your lifetime. It is a single-use IRS token. You cannot do $10,000 this year and $10,000 next year. You have to use the provision in a single tax year. If you are terrified of running out of money, but want to reduce your taxable IRA balance before the government forces you to take RMDs, this is the exact tool you should be discussing with your financial planner. Let's shift gears for a moment and talk about your ability to actually save money. For decades, the IRS had a very strict, unapologetic rule. The moment you turned 70 and a half, you were legally barred from contributing another dime to your traditional IRA. The government wanted you taking money out, not putting it in. It was incredibly frustrating for people who loved their jobs, wanted to keep working in their 70s, and wanted to continue shielding their income from taxes. But one of the most powerful changes in recent years completely eliminated that age restriction. Today, as long as you have earned income, you can continue fully funding your traditional IRA at age 75, 80, or even 90. The tension is that most retirees, and frankly a shocking number of tax preparers, still operate under the old rules. They assume the door slams shut at 70 and a half. If you are consulting or working part-time, you can contribute up to $8,600 into an IRA in 2026. This allows you to aggressively lower your current tax bill, even if you are simultaneously being forced to take RMDs from other accounts. But the real payoff here is how this interacts with spousal contributions. Suppose you are 72, completely retired, and have zero earned income, but your spouse is 68 and still working. Because the age limit was abolished, your spouse's earned income can be used to fund an IRA in your name. You can effectively continue to shield thousands of dollars from the IRS using your spouse's paycheck, reducing your joint taxable income, and building more tax-deferred wealth. Are you starting to see how these invisible levers can change your financial trajectory? Let me ask you a question. How much of your current retirement savings do you actually need to survive the next 5 years? If the answer is not much, you need to pay close attention to this next strategy because it prevents the IRS from forcing you to take out money you don't need. This is the fourth strategy, the QLAC, or Qualified Longevity Annuity Contract. When you turn 73, the IRS looks at your total traditional IRA balance and forces you to withdraw a specific percentage, whether you want to or not. If you have a large IRA, that forced distribution can be devastating to your tax situation. But the IRS allows you to take up to $200,000 of your IRA funds and purchase a QLAC. A QLAC is a specialized insurance contract designed to do one specific thing: provide you with guaranteed income late in life. But the immediate massive tax payoff is that the $200,000 you put into the QLAC is instantly erased from your IRA balance for the purpose of calculating your RMDs. You are legally hiding $200,000 from the IRS's mandatory withdrawal math. If you buy a QLAC, you can defer taking any income from that $200,000 until you reach age 85. For 12 to 15 years, that money sits completely insulated from the tax code. It does not generate forced taxable distributions. It does not inflate your adjusted gross income. It protects your Medicare premiums and your Social Security taxation. And then, at age 85, when you might be facing massive long-term care or medical costs, the QLAC turns on and provides a massive guaranteed stream of income that you cannot outlive. It is the ultimate longevity insurance policy that doubles as a tax-dodging shelter in your 70s. And yet, less than 3% of eligible retirees ever utilize a QLAC, simply because they don't know the IRS allows it. We are a little over halfway through our list, and in just a moment, I am going to reveal the single most important exception the IRS grants, an exception that allows you to completely ignore the RMD rules altogether. But first, we need to address the most urgent window of opportunity in your financial life, the Roth conversion sprint between age 70 and a half and age 73. Most people think that once they hit their 70s, their tax destiny is locked in. You are just waiting for the IRS to dictate your RMDs. This is a fatal financial error. The years between your retirement and age 73 are frequently the lowest tax bracket years of your entire adult life. You have stopped receiving a paycheck, but the forced IRS distributions haven't started yet. This is your golden window. The IRS fully allows you to execute Roth conversions at any age. You can voluntarily move money from your traditional IRA, pay the tax now at your current incredibly low bracket, and move it into a Roth IRA. Once it is in the Roth IRA, it grows tax-free, and more importantly, Roth IRAs have absolutely no required minimum distributions during your lifetime. The tension is that paying taxes voluntarily feels unnatural. It feels like you are losing, but the payoff is staggering. If you wait until age 73, the IRS is going to force you to pull that money out anyway, but they are going to force you to do it while stacking it on top of your Social Security, pushing you into a higher tax bracket. By proactively converting exactly enough to fill up the 12% or 22% tax bracket when you are 71 and 72, you are permanently diffusing the RMD tax bomb. Every dollar you move to a Roth is a dollar the IRS can never touch again, and it is a dollar that doesn't trigger Medicare surcharges later in life. It requires writing a check to the IRS today, but it saves you from being financially bled out by the IRS for the next 20 years. Now, let's talk about the absolute best exception in the entire IRS playbook. This is strategy number 6, the still working exception. I have seen retirees panic because they are turning 73, they are still working at a job they love, and they realize the IRS is about to force them to take RMDs while they are still drawing a high salary. Stacking forced IRA distributions on top of a peak career salary is a recipe for a catastrophic tax bill. But there is an emergency brake you can pull. If you are still working at age 73 and you do not own more than 5% of the company you work for, the IRS allows you to indefinitely delay taking required minimum distributions from that specific employer's 401k plan. You do not have to take a dime out of that 401k until the year you actually retire. You could work until you are 80 and the money just sits there, compounding tax deferred, completely shielded from the RMD rules. But here is the massive trap that catches thousands of people every year. This exception only applies to the 401k at the company you are currently working for. It does not apply to traditional IRAs. It does not apply to 401ks left behind at former employers. If you have an old 401k from a job you left 10 years ago, you will be forced to take RMDs from it at age 73, even if you are still working somewhere else. The payoff strategy? Before you turn 73, you roll all of your outside IRAs and old 401ks into your current employer's 401k plan, assuming the plan allows roll-ins. By consolidating your funds into the active 401k of your current job, you can use the still working exception to shield your entire retirement nest egg from forced distributions. You are legally hiding your money under the protective umbrella of your active employment. Finally, we arrive at strategy number 7. This is for the person who made a mistake. The tax code is overwhelmingly complex, and despite their best intentions, thousands of retirees miss their RMD deadline every single year. Maybe you got sick, maybe your broker made an administrative error, or maybe you just got confused about the new age 73 rules. Missing an RMD is one of the most heavily penalized mistakes in the entire tax code. The IRS used to confiscate 50% of the money you failed to withdraw. Recently, Secure 2.0 reduced that penalty to 25% and potentially 10% if you fix it quickly. But even a 10% penalty on a $40,000 required distribution is a massive blow to your savings. Here is the secret the IRS doesn't advertise. You almost never have to actually pay that penalty if you know exactly what form to file. The IRS provides a specific mechanism to request an automatic penalty waiver, and they are incredibly forgiving if you follow their exact steps. If you realize you missed an RMD from last year, do not panic, and absolutely do not just ignore it hoping they won't notice. Step 1. Immediately take the missed RMD out of the account. Step 2. File IRS Form 5329. You must fill out the line for the RMD penalty, but you write RC next to it, which stands for reasonable cause, and you enter 0 for the penalty amount. Step 3. You attach a brief, honest letter explaining the mistake. You write that you suffered a medical emergency, or you were confused by the changing Secure Act age rules. You have now taken the distribution, and you have taken steps to ensure this will not happen again. In nearly every single case where a retiree self-reports the error, corrects it immediately, and files Form 5329 with a reasonable cause letter, the IRS waives the penalty completely. They just want the money out of the account so they can tax the income. They do not want to crush you with penalties if it was an honest mistake. But if you don't know about Form 5329, your accountant might just calculate the 25% penalty, have you pay it, and the IRS will happily cash your check. Knowing how to ask for forgiveness is literally worth thousands of dollars. We have covered an immense amount of ground today, navigating the hidden rules that activate the moment you turn 70 and a half. Let's briefly recap what we've learned so you have a clear plan of action. First, you must stop giving cash to charities and start using qualified charitable distributions to erase the taxes on your giving and protect your adjusted gross income. Second, consider the one-time $55,000 QCD to a charitable gift annuity to turn a taxable liability into a guaranteed lifetime pension. Third, remember that the age limits are gone. You can still contribute to a traditional IRA as long as you have earned income or use a spouse's income to do so. Fourth, if you want to push off forced distributions until age 85, a QLAC allows you to legally hide up to $200,000 from the IRS math. Fifth, use the golden window before age 73 to execute targeted Roth conversions, permanently diffusing the RMD tax bomb at lower tax rates. Sixth, if you are still working, consolidate your accounts into your active employer's 401k to utilize the still working exception and delay RMDs indefinitely. And finally, if you ever miss an RMD, immediately take the distribution and file Form 5329 with a letter of explanation to get the penalty completely waived. Retirement is not a passive event. It is an active, ongoing strategy to protect the wealth you sacrificed your entire life to build. The IRS has left these doors open for you, but they are never going to tap you on the shoulder and remind you to walk through them. It is entirely up to you to take control of your financial destiny. I want to hear from you directly. Which of these 7 strategies were you completely unaware of? And which one are you going to implement this year? Go down into the comments right now and tell me your experience with these rules, especially if you have ever used a QCD or faced a penalty. Your experience might be the exact warning someone else needs to hear today to protect their life savings. Stay vigilant, stay informed, and I will see you in the next breakdown.